let's talk about something that should be near and dear to everybody's heart, Michael. And if you were to pick the number one commodity that every owner should cherish more than the blood pumping through their damn veins, what would it be?
Yeah, well, I've said this before. If last webinar we did was leadership, right? That was number one thing that we pinpointed. But if leadership was number one, this is probably 1A, and that's cash. Got to have cash. Cash is the number one resource, and I've heard you say this a lot. You can't pay bills with revenue. You can't pay bills with hope. You can't pay bills with this. The only thing you can pay bills with is cash.
You can't even pay bills with profit.
Right, exactly right.
You need profit, accrued profit, to turn into dough, cash, dinero, buccaroonios, right?
That's right.
So to me, I think that while people are fighting through this pandemic, I think people have been so caught up on, can I get through the day, the next minute, the next hour, instead of saying, all right, let me actually start planning accordingly based on where I am and where I need to go. And I hope that's what you're going to be showing people a little bit of today. Is that the plan?
Absolutely. We're going to do the next couple webinars that we're doing is all about cash and cash management. And today specifically, we want to get into how do you forecast? How do you start with where you're at today and build a forecast so that week to week to week to week you can determine where you're gonna land, and then you're using that information and turning that into a cash management strategy that revolves around how we're going to operate, how we're going to manage our people, and what do we have available. And more importantly, if you see that you don't have enough cash to survive through this 3 months of hell that we've been talking about,
which by the way, I need to correct that, but go ahead.
That's okay. But how are you going to what are you going to put into place to do that? And the reality is a lot of people that I'm talking to, they don't have hoards of cash. Some businesses are much better off than others, but I would say on average, the people that we're talking to, 3, 4, 5 weeks maybe. And so one of the things that we want to try to do through these next couple webinars is how do we determine that, and then how do we make that 3, 4, 5 weeks become 6, 7, 8 weeks?
How do you stretch what you got?
Right, exactly right.
How do you make it pieces fit?
Exactly right.
One of the things I wanted to correct is that we've been talking about 3 months of hell. Mm-hmm. I think it's 3 months of hell going to be followed by 3 months of hell.
Yeah.
So I actually think it's going to be the remainder of 2020, right?
Mm-hmm.
So we have to be sharp on how we show people and how we help people.
Sure.
But the thing I am the most proud of, and for anyone that doesn't know about us, we've been in business for 34 years. We were selected by the United States Conference of Mayors back in 1998, 1999 to be the exclusive partner with all the mayors. There's about 1,300 mayors in the United States at any point in time. We're the exclusive partner with the Conference of Mayors, the only consulting firm that they partner with, and the only consulting firm that they endorse working with small business around the country. We could talk about all the things we've done with Forbes and Wharton and blah, 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 blah. But right now, who cares? The only thing that matters is how many clients went under of ours during COVID-19.
Not a single one.
How many?
None. Zero.
None. And any of them have a plan when COVID hit?
None of them.
And when COVID hit, did they have a plan?
In hindsight, I went back and we started laying out a plan on March 3rd with all of our clients. First shutdown, I think, was California, and that was maybe 3, 4, 5 days later. So we were three steps ahead of what we anticipated happening with the shutdown.
And did our clients appreciate that we brought them a plan?
Absolutely.
Put it in writing and taught them how to get through it.
Yeah.
And I want to repeat again, did we have any client go under, belly up, fail?
None.
None, not a one, right? Because they had a plan and we put it.
Yeah.
And liquidity and cash is part of that plan. Is
That's
that
right.
correct?
Big
Okay,
part of it.
so folks, my name's Lou Mosca. I'm the Chief Operating Officer of American Management Services. I've been doing this for coming up on 22 years come this August. And obviously what we're going through right now during this coronavirus pandemic is absolutely batshit the craziest thing we've ever had to deal with. By far, craziest thing we've ever had to deal with. And before I introduce you to Mike Lockey, who you've all heard and talked to before, I hope, I want you to remember that back in 2009 and 10, the owner of our company, George Cloutier, penned a book, Profits Aren't Everything, They Are the Only Thing. And in that book, he screamed, cash is king. Michael, how you doing?
I'm doing well. As Lou mentioned, my name is Mike Lockey. I'm the Director of Management Services for American Management Services. I work directly hand in hand with our clients, with our consulting staff, and cash in normal times when we walk into a client, one of the first things we touch and do this. So let me ask you a question, just for a quick discussion. When we walk in, usually a business owner says, well, I can go out to my bank, my site, and I can pull up my account and I can see I have X dollars in the account. Why is that not good enough?
Well, quite frankly, every owner should know why that's not good enough, right? Because the money you have sitting in your bank account today is actually irrelevant. It is just a starting point, a tipping point. It's just where you're going to begin to manage your cash from, right? So if you have $1,000 in the bank, how does that reflect what checks are still outstanding, or what wires didn't go out or didn't come in, or what ACHs didn't come out and didn't come in? So certainly you start with what you got, but the difference between a bank balance and a book balance can be dramatically different. Sure. Plus, add to that, what happens if you have $5,000 in the bank and that $5,000 came from you drawing down on a $50,000 line of credit? So basically you have no money if the money in the bank is your line of credit money. That's not your money.
Yep, that's right. That's right. So great. I think this is a great way to start. Today's lesson, to this webinar that we're on right now, is all about helping develop the cash forecast. So
you're actually going to walk them through how to do this mechanically.
Yep, we're gonna go through it first, and then we're gonna put up a whiteboard, and we're gonna actually pencil out some stuff for them. But let's start with a couple fundamentals that everybody will need to know and understand. First, as always, be real with your situation. In all likelihood, you're impacted in some way. Whether again, we've heard businesses say, "I'm running full speed. I've never been busier." Blah blah blah. You're probably impacted in some way. Two, as you're putting your cash forecast together and ultimately a cash management plan, the reality is you're probably not going to make everybody happy. This isn't an exercise to say, how do I make everybody happy? This is an exercise to how do I survive? Do I have enough information to survive? So it's going to be unlikely that you're going to have a situation where you can cover all of your payments through this.
The reality is you got to get from where you're at today to where you think that end line is going to be.
Yep.
And you can't plan out 6 months, but you can start to think out 6 months, and let's go in maybe 2, 4, 6, 8 week increments. Is that about right?
That's right.
Okay.
That's right. Third, we're not going to try to turn anybody into accountants or finance experts or all this. As a business owner, you do need to know your numbers. You need to have a fundamental understanding of it. But we're not trying to give you a master's degree in accounting at this point.
You referenced one of our consultants the other day when you did the jigsaw puzzle and actually knocked my head off because I can't do a puzzle. Well, one of our other consultants say you go by the numbers because numbers don't lie.
That's right.
People do. So as an owner, you don't want to be fibbing to yourself. You want to be accurate, real world, where you're at. Don't be surprised. Manage to your result.
Yep. The next thing is when in doubt, keep it simple. We're not trying to balance to the penny. What we're trying to do is get a somewhat realistic picture of where you're going to be. So if you're being realistic and you do your numbers, I don't care if, we're not trying to get to the penny. Round, do whatever you're necessary. Give yourself kind of a rudimentary understanding of where you think you're going to be at. Because what's important isn't putting numbers on a piece of paper or isn't doing the forecast per se. It's what are we doing with it. And if you don't give yourself a realistic outlook of where that is, or you get too bogged down in the details, too muddied up, then you're not thinking about how can I improve upon this. You're thinking about, is this right or wrong? There's really no right or wrong. Just give yourself a realistic shot of where you're at.
As I've gotten older, I've become more of a storyteller. And about a month ago, 3 weeks ago, I had a call from an owner of a business, and his mother was a mayor. Okay, and business was in the Midwest, and he proceeded to tell me. I asked him what kind of cash management he did, and he didn't, all right? As most don't, he didn't. So he told me how much cash he had in the bank. We mechanically, on a piece of paper, right there and then on the phone, added up what he needed to pay for the next 3 months, by month. Rent, utilities, phone, food for himself, his personal rent. He had already laid off all of his staff. And when you did the math, he couldn't get through a month and a half.
Yep.
So I said to him, these are some of the steps you're going to have to consider to take action on.
Right.
And he said, I don't want to do that. And I said, well, then you make your own decision, right? So he called me back 3 weeks later and he said, damn, I should have done that. I'm out of money.
Yep.
All right. And the fact of life is hard decisions.
Yeah. So I've even had this conversation even with some of my consultants. I tell them, I don't care if we have a cash forecast written out on a napkin. How you do it isn't the important thing. What you do with it is what's important.
Sure is.
But this is
Make it a tool, a
right,
functional
exactly.
tool.
This is going to be a two-step process. Today we're going to show you how to put it together, and then the next webinar we're going to show you what do you do with this information.
Cool.
How
That's
we go.
great. Okay.
So now one thing that's good about this is we're going to give you a template that you can download that you can do your own, whether you want to pencil it in, whether you want to do it. It's on an Excel sheet. You can plug the numbers in yourself and then print it. We're going to give you a couple blank templates so you can play the what if game. I can change this scenario and this and move things around and all that stuff. But for now, we'd like for you just to watch and listen. We're going to go to the whiteboard. We're going to start putting stuff on the board to give you the visual, and we're going to give you kind of a simple example of how it works that you can then take and use that in your own model. So sit back, watch and learn, take some notes. So as we go through our example on the board, the thing that I want everybody to kind of ingrain in their mind is the simple formula, and I use a term called BASE, BASE. It's an acronym, and it stands for the
Third base?
Third base.
Okay.
No, the B in this acronym means beginning balance.
Sure.
And we're going to go through these in a little bit more detail. The A is you're adding in cash that's coming into you.
Okay.
The S the S is subtract. And what are we subtracting? Any cash flow that you have going out, payments that you're making. And then that leaves the E, which is your ending balance. And the formula goes like this. Your beginning balance, adding in what you're expecting to come in, minusing, subtracting out what's supposed to be going out, leaves you with an ending balance. Real simple, right? Four things. Beginning balance, add in cash in, subtract out cash flow out, leaves you with your ending balance.
So where would cash in come from?
Okay, so let's talk about what your beginning balance is.
Sure.
Your beginning balance starts with what you have in the bank today, right? Now, obviously, that can be adjusted if you have cash or things that haven't cleared the bank yet. So you got to keep that in mind. And then, as you mentioned earlier, can also include borrowings and availability you have against lines of credits or other sources of money.
Which we don't usually like, but in these times,
Yeah, I
you sort of
think-
got to look at everything.
Yeah, I think when you're in survival mode, you got to look at all available resources. We also see clients that kind of play some tricks with that. For instance, they may have a business checking account that they use predominantly to pay their vendors and normal bills. Then they may take some of that money out and put it in a separate account for things like payroll, and they may be carrying balances over there. And I think in this time of survival, I think you got to make sure you're including all of that. Any penny that you have kind of should be included in that beginning balance. Now you can be a little bit conservative with that. You can say, hey,
Yeah,
what,
but
I'm
this
putting
is
this
war.
over
The
there.
rules are off.
Right, exactly. So just be cognizant of again, no right or wrong here. And I'd rather you err on the side of being conservative so that you have a little bit more cash than what you think you have. But you want to be realistic with this. If you have this amount available for cash, you got to be able to bounce that off against what you have coming in and what you have going out. So let's talk about the cash flows in, and really predominantly there's kind of two areas, right? Your cash sales. So if you're a restaurant, you come in, somebody pays you with cash, that's cash flow in. Or you can have credit collections, meaning I sold you something 30 days ago. You're sitting on an accounts receivable, and I expect that payment to come in. Now, there's some other things that can happen there. A couple things, actually. One, you can borrow against your line of credit, so that would technically be converting that availability into cash for you. And the one that I'm leaving out for the time being, but it's probably something we should mention, is what if I get money from the government in some fashion? So, but
You also got to be careful, too, because a lot of times if you have a line of credit and you're going to borrow against it, you're borrowing against a receivable. So as you
Right.
collect the receivable, the line of credit changes.
Very true.
So, but we're not going to try and turn this into
Right.
an engineering schedule here, right? Okay.
Right. Well, you the idea is as you go week to week to week, you can refresh that, right? If your receivables are
Right
going
now,
up
you
or
need
down,
to be doing this daily.
right? Well, no doubt. Now let's talk about our outflows. Pretty easy, right? We kind of categorize them a couple different ways. One is what we call recurring payments, right? And the other side of that is what am I paying for vendors and supplies? And Lou, why don't you list a couple examples of what we mean by recurring payments?
Paying you. We pay you every damn week. No. So a recurring payment would be your rent. If you have debt service that has to hit on a certain time, You probably have scheduled insurance payments that for liability or workman's comp. If you're in business, every business requires workman's compensation. You might have utility payments that are recurring, but there are basic things that are recurring to put the key in the door and turn the lights on.
Yeah, I think to make it simple, my kind of definition for recurring payments are things that are relatively consistent in both timing and dollar amounts. So like you said, your insurance payments, you probably are financing your insurance. It's an amount that you pay every month. Your payroll, whether you pay it weekly, bi-weekly, probably pretty consistent week to week to week, or payroll period, payroll period, payroll period. Your utility bills, they probably fluctuate a little bit, but they're probably, stuff that you can reasonably predict when you're going to pay it and how much you're going to pay. And again, we're not trying to get it down to the penny. We're trying to just say, hey, on average, I spend about $5,000. My utility bill is $5,000, and I have to pay it by the 15th of each month. There you go.
If you don't know, your utility company will tell you what you pay on average each month.
Sure.
All you got to do is ask them.
No doubt, no doubt. On the flip side, and the reason we kind of separate out vendor pay is because I think a couple things there. One, it's not always predictable what that amount needs to be, because it should ebb and flow with your revenue, right? Because you're buying more or buying less relative to what your activity, or at least you should be. And it's not always predictable, the timing of it. Now, you could probably make an argument that sometimes when you're buying, you're on some type of repetitive pattern with them, but that's not always the case.
Part of the challenge with vendor payables, the way I see it, is that if you're buying on 30-day terms and you're extending 30-day terms and you want to keep good faith with your vendors, you try to live up to your payment terms. But nowadays, people are not keeping good faith potentially with you. So you have to look at what's coming in, and you need to be honest with your vendors as to when you can pay them. That's number one. But number two is there's usually a lag. So if things slowed down March 1st or April 1st, but you had bought stuff in the prior month, it's still coming due. You need to deal with how you're going to be paying that. So vendor payables are definitely somewhat discretionary once you get over the lag period.
Yeah. So, and then that leaves us with our ending balance, which is just simply the sum total of those three elements. So let's assume you had $10,000 of beginning cash availability. You bring in $5,000, so you have $15,000 total between cash you had and cash you brought in. And let's say you're spending $6 is going out the door, you would end up with $9,000 ending cash balance. So your ending cash balance is just a calculation to get you there. So again, it's taking what you had to start with, what you're adding to that by bringing in, and then what are you paying out, the net of those three things.
Sounds kind of simple, but that's just the numbers on the paper are simple.
Sure.
And where people seem to get caught up or have challenges when they actually do this their first time and they're not happy with the numbers, they don't want to do it.
Yeah.
And we're suggesting whether you like it or you don't like it, it's your lifeblood.
Right.
Do it every day.
Yeah.
But just putting the numbers on paper is a start. Now you got the work to do.
Right. So we're going to let's walk through a simple 2-week example on the board. Now when what we're asking our owners to do is to do this for an extended period of time, and normally we recommend 8 weeks. And I think for this day and age, let's try to target getting to the end of June. That's our 3 months. But
let's teach it in 2-week increments.
Let's give you a simple example just to see, so you can see how that works.
Go ahead.
Okay, so here we are, we're at our whiteboard, and as you can see, I've written out our base concept, and the components again are B being our beginning balance, A being what we're going to add in, we're going to add our cash flow in, S is what are we backing out, subtracting, or we're going to subtract our cash flows out, and all of that, beginning balance plus what we add minus what we take out will lead to our ending balance. So let's write in some numbers, and this is a real simple, easy example. Let's say we're going to think in terms of a week. Say you start your week with $10,000 of available balance. That's what you have in hand, that's available under your lines of credit, that's where you're starting. And let's say you expect to do $5,000, or we have $5,000 coming in. So we're going to add $5,000 to that. So 10 plus 5 is 15,000. Now let's say you look at your payables, and we're going to expect to pay out $4,000. And we'll put that in brackets. Okay. So then your ending balance is simply what we started with, 10, what we expect to come in, 15,000, and then of course backing out what we're expecting to go out the door, $4,000. So 10, 15 minus 4 is 11,000. That's your ending balance. If XYZ Inc. has $10,000 of available cash and could borrow another $10,000, we're going to assume that they have $20,000 available to start. There's their beginning balance. There's the B. Right. Let's assume that XYZ, they normally receive about $30,000 in cash sales per week. So as you can see, I've got add cash flows in, our cash sales, 30,000. So we normally do 30,000 a week, but let's skip over to now week 2. And if you see at the top, I should have pointed this out earlier, we have our 2 weeks, and we're going to say current week, week ending 4/25, which is this coming Saturday. And then we have our second week, which is week ending 5/2. Let's assume for a second that we expect our sales to decrease slightly week to week. Now, as you're doing your cash flow, that could go significantly down, or maybe you're already operating there and it goes even further in the hole. So you're going to have to make an estimate as to what those numbers should be based on your experience, your knowledge, what you know and understand is happening today. Now, we input our cash sales, but let's say you also sell to some of your customers on credit. So what you're going to have to do is determine how much week to week do I expect to come in. And again, this day and age, that might be easier said than done because your customers might be conserving their cash balances. So it may be difficult to do that, but you got to use a realistic expectation for something. So let's just say we expect another 10,000 of our accounts receivable to actually be paid in week 1. And let's extend that out and say we expect another 5,000 come in week 2. So there you go. There's our A in the equation. Okay. Now let's talk about our cash flows out. Now look, I've listed 6 things right here. You may have more, you may have less. What I encourage you to do is be simple. Consolidate things. Again, we're not trying to balance to the penny. We're trying to get a realistic vantage point of what this number is going to be at the end. If you need more categories, put more in. But I tried to pare these down to the most important things that you're probably dealing with today. Okay, so let's start off with our payroll first. And let's assume that on average, you pay out about $15,000 each week in payroll. Okay, there's that. Now let's talk about rent. You don't pay rent week to week to week in all likelihood. You have one facility, you probably have one monthly rental payment or mortgage payment or something along those lines. So let's say in week 1, you don't have anything, but in week 2, you have to make your rental payment of $5,000. Okay, now in reality, if you're going a long period of time, you may have 4 weeks. You might not have it in week 1 or week 2, you might have it in week 3. But for this example, I just want to show you what it kind of looks like. Insurance payments, same thing. You're likely going to have one payment at one time a month, or if you have a lot of numerous policies or separate carriers or whatever, you may have 2, but they're always going to come usually once a month. Let's just say for our example purposes, your insurance is due right here in week 1. And if we come across to week 2, we don't have that payment. Again, if we were to extend that out a few more weeks, at some point you're going to run into another $15,000 payment, okay? Let's say you have some loans for some vehicles, equipment, whatever the case may be. Same thing. Usually you're going to have one monthly payment. Now, if you have individual loans for all of your various pieces of equipment or vehicles, say you have 5 separate vehicle loans, again, this could be timed out. You could have one in theory per week. We're going to assume we have one equipment loan, and again, you pay it once a month, and that, in our example, we're going to put in week 1. Which means, again, in week 2, we have nothing. Again, you're gonna slot it where you need to slot it within your cash flow forecast. Utility payments, same thing. Usually you have one payment a month, could be broken out between water and trash and electric and all those things, but we're just gonna assume one payment. We're gonna assume that our timing here is week 2. And let's say $7,000. Okay. And finally, you're going to have to pay for supply. You're going to have to make vendor payments. And we assume that each week you average about 8,000. Okay, so again, this is going to have to be based on several things. How much credit you have with your vendors, how much you've been able to negotiate terms and conditions. I just used an average number here, but you can actually practically kind of predict what that is. You can use your invoices as the barometer, what you have on your accounts payable, and then you can make the determination of how do we shift that around a little bit to help improve our cash position. But for now, let's just say on average you pay about $8,000 a week. So now we have our beginning balance in, we have our cash flows in that we're going to add, we have our cash flows out that we're going to subtract, and the last piece of this puzzle is our ending balance. So if I take my 20,000 and to that, add 30 and another 10, that's going to be 60,000, right? Let's just kind of put a subtotal here. Okay, then from that 60,000, from my beginning balance and my cash flows in, now I'm going to subtract out my cash flows out. So I have 15, 30, 35, 43,000. I don't have a room to put that in there, but understand that's 43,000. So my ending balance, my 60,000 less 43,000 is going to be 17,000. All right, that's my week one. Okay, now here's the trick. Where I end up in week one ending balance now becomes my beginning balance for week two. So I carry over this 17,000, and that's now my new beginning balance, my B, for week two. Okay, so now we just go through the same exercise. Start with my 17. I'm going to add 25,000 to that. That's the cash coming in. That's my A in that equation. So that gets us to 37, 42,000 here. Okay, then I come back to my subtract cash flows out. I got 15, 20, and another 15. I've got 35,000. So 42,000 less my 35,000 comes out to 7,000. Okay. Now, if we were carrying this further, which you should be doing when you're doing your cash flow projection, this 7,000 would, in theory, now become your beginning balance for the third week, and so on and so on. You'd anticipate your cash coming in, your cash flows going out, and come to your new balance. So that, in a nutshell, is a very simple example of the exercise that we're asking you to do as you go through and build your cash flow model. It's as simple as that. Again, you can make that pretty extrapolated. You could have 30 different line items. My recommendation is keep it very simple. Keep very, very high level things in there and make sure that you're monitoring all of that cash flow out. So we've mapped this out on the board, but this essentially mimics the downloadable sheet that we'll have. You're going to see all of these components: my beginning balance, what I'm going to add in, what I'm going to subtract, and what my ending balance is. And the important thing to know and understand is it's not this that matters. What this is doing is getting you to this. What we're really trying to determine is week to week, where are we at? Now notice in our example, from 425, we went from $20,000 down to $7,000. Now, if we kind of assume a similar trend, you're going to be below zero by the time we get 3-4 weeks out. What we really need to start thinking is, how can I raise the bridge or increase our cash flows in, or how can I lower the water, reduce our cash flows out. Now you can shift things. Maybe if I can't make this 5,000 loan payment, maybe I can shift that out to this week. That would increase your cash here, but as long as you shifted it 1-to-1, you're still going to end up at 7,000 there. So part of your plan, if we're talking strictly lowering the water, because we think raise the bridge will be very difficult to achieve just with the given situation, just merely shifting things out is going to give you some things, but you got to shift them out farther. You can't just take 15 here and move it 15 here because you're still going to end up with 7. What we would really like to do is come up with a plan to say, I started with 20. Is there a way that I can end with 20 out there? Now, you brought in 40,000 here with the 20 that I have, and if you're trying to end with 20, that means I can spend 40 here. And what did we spend? We spent 30, we spent 43 here. So if I could cut 3,000 off here, I can match what I have in here, and I could end up this week at the same 20,000 I started with. That would carry over here. And then we would have to figure out how, if I started with 20, how can I end with 20? And we call that cash neutral. As much cash coming in and as much cash available, it doesn't change from week to week to week. So we want to, at a minimum, for you to survive, you want to try to stay as cash neutral as possible. Obviously, if you can get cash positive, meaning I started with 20 and I end with 21, 22, 23, 24, or something higher than that, that's ideal. But what we're trying to talk about is survival through this period of time. So we want to think of practical ways of how we can lower the water, push those out, because remember, we're in our plans, we're not telling vendors we're not going to pay you at all. What we're going to do is pay a reasonable amount so that we can survive in the short term with a long-term plan of how we make you whole once things get back to normal. So our goal is to try to, if we start with 20, how do we maintain 20 as far out into the future as we have? And the reality is some of you might be cash negative. Some of you are going to be dipping into your cash and it's going to be decreasing. Still the same exercise. How do we take these costs and push them out or mitigate them as we go further and further out? So when you get our template, we want you to start with where we're at today. At a minimum, carry that out through June, doing this exact same exercise, and let's see where you're at. Now the next step would be, what do we do with that information once we got it on the paper?
So finally, guys, just because you completed your cash forecast, just because you've got this template now that Mike's provided for you, and it's kind of simple, and you've seen how to slug the numbers on here, that's the easy part. The hard part is turning this into a tool. So leave space for you to document your actual versus what you're projecting. Be micro analyzing every penny of where it's going, where it's coming from, and don't let up. Your cash flow forecast should be your lifeblood on how you're going to proceed. Yeah. Take us home, Michael.
In summary, developing a good cash flow model is only the first step in developing, designing, and implementing a sound cash management procedure for your business. So keep it simple, be realistic with your estimates. We give you the downloadable templates to help you use. Again, it's not the numbers that matter, it's your plan to develop. And finally, don't do this alone. If you need help, reach out to someone that can help you put this together.
I have a last question for you.
Sure.
So if we have a client that's got $3,000 in the bank, do we do a cash flow model?
Absolutely.
If we have a client that has $3 million in the bank, do we build a cash flow model?
Absolutely.
Absolutely, right?
We're going to start the next webinar with that.
There you go. So perfect. Guys, I hope you got value out of this. If you didn't, watch it again.